Howdy, Jacob here. Today we're looking at CAE in the aerospace and defense industry. Just under 6 billion market cap, 7.5 billion enterprise value. They provide simulation training and critical operations support solutions in Canada, the US, pretty much globally. Founded in 1947 in Canada. Growth is surprisingly impressive for a company as old as that. 1.8 billion in revenue in 2015 to 3.1 billion in 2024. We are seeing a flat gross margin and a slight decline in operating margin, but 10-11%, really not bad. Earnings per share side, though, getting negative. I wonder if that's interest. We'll have to look at that. They removed their dividend from pre COVID and have not incorporated it back yet. Okay, other non operating income. Okay, probably converting goodwill, I presume, to you make an acquisition, you buy them for $1 billion. A couple years later, realize wasn't worth it. That's what's happening very likely here. Net interest income going up too, but not terribly concerned about that. So the free cash flow statement should be more transparent about cash in, cash out. But first, the balance sheet: 118 million cash on hand, 187 million short-term debt, long-term debt 1.7 billion, and as expected, right here, goodwill you can see reduced about 500 million. So that's what that non-interest incomes was. But 1.7 billion in debt, 118 million cash on hand. That's a good amount of debt there. Let's say 1.7 versus their free cash flow producing about 170. So that's pretty much 10 times 5-year average free cash flow, which is not great for them. Obviously, free cash flow does look better in their earnings though. That's positive. But again, this big acquisition, 2022, I guess, yeah, goodwill, big acquisition, had to write it down. Wasn't worth what they thought it was. Anyway, the debt is a good amount of their capital allocation, at least in the last couple of years. They've made some big acquisitions in their last 10 years, but yeah, it doesn't necessarily look like they're fantastic at making acquisitions, at least from what the numbers are saying. So let's get to it with our assumptions here. On the revenue growth side, I think that if they start making some better acquisitions, 5% seems reasonable. Their margins have been, I'll probably just stick with more of the cash flow statement. Let's maybe do 5 and 7. Share change 1%, 60 million. Offset stock-based compensation. Okay. Just going to offset stock-based compensation, it looks like. Terminal PE, price to free cash flow, 5%. Maybe you have a little bit of net debt, maybe a little bit less than market average. So this is assuming 5% revenue growth. To get that, they're going to have to allocate maybe 60%, 70% of their money towards acquisitions and reinvesting back into themselves. They're really paying, this is just offsetting stock-based compensation. It's like 5% of capital. And then we're still leaving a good amount of room for debt reduction here. Whether they actually do that or not is a different story. But right now they have about 10 times their 5-year average free cash flow, which is a good amount. And so I'm leaving capital allocation to reduce their debt figure quite a bit. And so even with that, it's quite a bit of a fall before you get the return we're looking for here. So I will be just waiting and finding better opportunities elsewhere for now. But I hope you enjoy the video and have a great rest of your day. Thank you.